And gentlemen, my name is Michalis and I'm the market analyst here at HF Markets. Today we're going to be looking at inflation. We're going to be looking at two key types of inflation. We're going to go straight to the announcement, so we're not going to miss the announcement. And today's webinar, we're going to be explaining and looking at two aspects of the financial trading markets. Number one, we're going to, of course, be looking at what is released in the US, what it means for US based assets as well as global assets. But then we're going to go straight to the MT5, to our trading platform. We're going to look at technical analysis. We're going to look at as well as fundamentals and price action as well. But what we're going to do is we're going to look to determine how that, ladies and gentlemen, can change the price action and how it can potentially create signals within the financial trading markets and how we can take advantages of these signals. So whether it's going to trigger a more expensive US dollar, a lot of people think it's going to trigger a lot more expensive US dollar. But of course, this is something that we need to see as soon as the announcement is made. So let's quickly refresh our screen and we can see exactly whether we're going to be looking at a higher inflation rate if inflation is unchanged, or if indeed it's going to come in lower. So here, ladies and gentlemen, we've got uh, both the core inflation and the official inflation rate. Now, what is the difference between the two? We've got the official inflation rate, which is a larger and broader basket of assets, whereas when we look at the core inflation, it excludes more volatile assets, mainly excluding, for example, food, alcohol, tobacco, which can be slightly more volatile. So keep in mind there's two sets of inflation data that we're going to be looking at. Now, the first is, of course, the uh, consumer price index, which is the official inflation data. The official inflation report has come in at 0.4%. So that is, if we're going to look at traditional levels where inflation should be, that is substantially high. It is higher than the previous month. Of course, we were predicting it to come in high. This, ladies and gentlemen, actually means that inflation isn't going to stay unchanged as we originally were expecting. When I say we, in terms of financial advisors, in terms of economists, in terms of large institutions, a lot of these individuals, they were expecting inflation to remain unchanged. We can see here, ladies and gentlemen, that it's gone from 3.1% to 3.2%. Now, that isn't necessarily substantially high or a considerable increase, but there's a very big domino effect which sticky inflation can have on the financial trading markets. For example, one of the things that it can potentially actually do is create a more expensive US dollar, and it can also create more pressure on the stock market. If we're going to look at the core CPI announcement, so here you can see consumer price index excluding food and energy. So as I'm stated previously, we've also got the core inflation rate. The core inflation rate, ladies and gentlemen, excludes more volatile assets. Now, this was actually expected to decline. We were expecting it to decline from 3.9% to 3.7%. Even if it did decline to 3.7%, of course, it's substantially above where the Federal Reserve's target is, but nonetheless, it would have been a welcome decline. Whereas actually, we've seen a decline, but we've seen the monthly core inflation data coming higher than expected. And even though we've seen a decline, we've seen a lower than expected decline. So, ladies and gentlemen, the decline is actually only 0.1%, which is lower than expected. Now, generally speaking, this can create some pressure in the stock market. But of course, what I always say when we're looking at analyzing the financial trading market is there's certain steps that as traders we of course need to take. Number one, we look at the news and what the news means for financial trading assets. We look at the domino effect that it can have in the trading markets. Of course, we're definitely going to take that into consideration. We can see inflation is higher when we're looking at the monthly inflation release, as well as what it means for the official yearly annual inflation. But it's not adequate enough in order for us to be able to determine where there is signals and where there is potential in the financial trading markets. We also need to take into consideration correlations, and we also need to take into consideration technical analysis. Now, technical analysis is when we're actually analyzing the price movements of each and every asset. Now, I'm actually going to bring up the MT5 onto our screen. And we're going to, let's actually start off with the US dollar. We'll start off with the euro against the US dollar because it is the most traded currency pair in the world. We're going to be using a simple setup at first, and then we're going to go slightly more into detail. But keep in mind, even though that this is a very simple setup, we have to take into consideration that this setup can really give us very clear indication as to whether buyers are controlling the market or sellers are controlling the market. So, ladies and gentlemen, when we're looking at the chart now, we can see there's two indicators. Number one, we have a 75 bar exponential moving average. So this is this green line here. And the other is a relative strength index, so an RSI on the 20 bar period. Now, what we can actually see here, let's go to a 5 minute just for a moment. Before we started to look at this chart, I did state that this announcement, now that it has been announced, and the fact that inflation is higher than expected, I did say that it can support the US dollar potentially and apply pressure on gold and apply pressure on the stock market, especially on the stock market as well, because it actually means higher interest rates potentially for longer. But we also have to take into consideration that there's always going to be volatility. So we have to be cautious about volatility because what actually is happening is all the way down here, ladies and gentlemen, there's a lot of individuals that without doubt are placing pending orders, for example. And at the moment, we don't have a depth of market on the MT5, but if people have a depth of market, they'll be able to see there's plenty of pending orders lower in the price down here, for example. So even though individuals potentially may not believe that the euro is going to increase against the US dollar now that inflation is higher, because of course we have lowering, declining inflation in the eurozone, but at the moment we've got sticky inflation in the US and actually rising inflation in the US. So of course, even though people may not believe the euro against the US dollar is going to increase in value, there's pending orders there and is automatically being entered within the market because people, for example, may want to take advantage of a lower price and a lower entry point. So most of the price movement is against the euro in the US dollar, but at the moment there's a lot of volatility. So we need to phase out that volatility in order to get a clear indication of how the price is likely to move. Now, the first thing I want people to note about this setup is that it's very easy, but it can be so helpful for individuals because there's a lot of individuals. I can see some people here saying they've made profit on gold. Others are saying they've made profit on the USD against the JPY. Maybe that individual was actually reading today's market analysis blog on our website because we looked on the blog at gold and we looked at the US dollar against the Japanese yen over the past few days as well. We looked at how that can actually create volatility. We actually did state that there was signs that the US dollar can become more expensive. So that's definitely something that we've seen so far. Now, when we're looking at these two indicators, there's two areas that we need to note. Now, if we're looking at the RSI and this area, we have four sections. We have above 75, between 50 and 75, and between 25 and 50, and below 25. Now, if the price is hovering between 50 and 75, it's indicating buyers are controlling the market. Now, of course, when we're looking at a currency pair, we've got two currencies. So if buyers are controlling the market, it means people are selling the dollar and buying the euro. Now, when we're between 50 and 25, it means sellers are controlling the market, so in favor of the US dollar. If it's above 75, it's too expensive. If it's below 25, it's too cheap. Now, if it's overbought and oversold, it basically means there's a risk that there may be a retracement, a correction, or that we're going to get individuals trying to fish for the top or trying to catch a falling knife and so on and so forth. Now, what are we seeing at the moment if we're focusing on the RSI? We're definitely seeing that buyers are controlling the market for sure. But what we actually started to see, and actually pinpoint when we started to see this as well, we started to see this on the 8th of March. So we're going back a few days now towards the end of last week. Towards the end of last week, even though we have buyers controlling market, we're actually seeing that buyers are losing control. So even though they're still controlling the market, according to this indicator, they are losing control. So that's definitely something we need to take into consideration. Now, the other thing for us in terms of this setup is that we're above the 75 bar exponential moving average. So if we're above the 75 bar, it's indicating buyers are controlling the market. So you can see since we've been above, we originally were above, ladies and gentlemen, since the 1st of March. Now, if we used that and traded since then, we could have at some point seen price movement in our favor of 155 pips. So this tells us if buyers or sellers are controlling the market. We're seeing though on the other side that buyers are losing control of the market, even though currently they're still technically speaking seeing indications that they are controlling. Now, we're trying to push downwards according to this price movement, but this price movement simultaneously is actually forming what is known as a price rejection candlestick. So at the moment, we're seeing buyers losing control. They're trying to actually break below. If they break below, then we can potentially start to see signals that sellers are going to start to control the market. But we need this to be backed by the price movement itself. So what people can actually see at the moment is that they're in that neutral area of the market based on this particular candlestick, that the neutral area. But if the candlestick starts to uh, gain momentum downwards, then it's an area where we've got signals indicating that the euro against the USD is going to decline, which is also being backed by fundamental aspects as well. So at the moment, we're in the neutral with the potential for the euro against the US dollar to decrease in value potentially. So, how do we reassure ourselves that it is going to decline and take the neutral signal into an active signal, which is materializing, indicating that the price is going to decline? So, how do we turn that on its head, ladies and gentlemen? Now, what we can do at first is we can switch onto a smaller time frame. And when we switch onto a smaller time frame like this, then we can actually start to use what is known as Fibonacci levels. So I'm drawing a Fibonacci level for the whole of the range of volatility. So for example, here we can see the range of volatility. Now, if the price is remaining above uh, 50 on the volatility levels, then we can take into consideration that there's still volatility and there's still momentum upwards. But when we're looking at by the price dropping below the 50 level on the Fibonacci, then we can start to take into consideration that sellers are gaining control. And this is something, of course, we also want to ideally see on the MACD, and ideally we want to see it on the RSI. So at the moment, we're seeing upward momentum. Now, if the price starts to decline, ladies and gentlemen, the price is here at the moment. If the price starts to decline and it drops below the 50, what is actually happening if that takes place? If we're dropping below the 50, we're most likely going to get enough momentum for the RSI to drop below the neutral level, to drop below the 50 as well. At the same time, we're most likely going to get the MACD declining further as well, and ideally the MACD drop below the neutral. So if it drops below the neutral, starts to look like this area here. And at the same time, if we do get the price dropping below 50, then we're very close to actually declining below this point here. So what we're actually forming is a lower low. And of course, if we're going to see a downward trend, we need to consecutively see lower lows and lower highs. So this is a very clear area where individuals can pinpoint, based on technical analysis, that signals may materialize at this area of the market, which will indicate that the price potentially can decline. So if the price does start to move downwards like this, ladies and gentlemen, then we can start to take into consideration that area of volatility. But like I've just stated as well, if we're going to be drawing the Fibonacci level at this area zone here, at the moment the the price is above the 50 on the Fibonacci. So at the moment we don't have any active signals, even though potentially we may not be actually seeing a signal active that the price is going to increase. We're not seeing active signals that the price is going to decrease either. Now, if we're going to look at the crossover, if I zoom in so people can actually see the crossover, then we can see we're neither seeing an upward crossover or downward crossover. So again, this is at the neutral level. Now, this is at the neutral level, ladies and gentlemen, because there's been a lot of volatility downwards and there's been an equal amount of volatility upwards. So, of course, based on that, ladies and gentlemen, we have a neutral signal. Now, as we're speaking, we're actually seeing the price start to cross over upwards. So if we do get upward momentum, keep in mind, if we get upward momentum, then potentially we're looking at all signals start to indicate that the price is going to increase. But this is only if we're able to maintain momentum upwards, because we have to really take into consideration that what is actually has been released within the market in terms of the core inflation rate and in terms of the standard um, in terms of the core inflation rate, and as well as, for example, the standard inflation rate. Both of them are signaling that the price of the US dollar may increase in demand. But if we gain momentum upwards, so if people are going to ignore that price movement, ignore that fundamental aspect, and starts to increase upwards, then we're actually going to get all signals indicate that the price is going to increase. Why? Because the price is above the 75 bar. It's above the neutral, even though it's slightly declined. It's above the neutral on the RSI. If we switch over to a 5 minute time frame, we're in the positive zone of the MACD. We've got an upward crossover and we're above the RSI as well. So you can see in terms of technical analysis, because of that very quick rebound, there's still a lot of scenarios, a lot of aspects, a lot of indicators which are still indicating the euro against the USD will increase in value. But we really have to be cautious about this because fundamental aspects in terms of the domino effect, ladies and gentlemen, can create a lot of demand for the US dollar, especially if inflation in the eurozone continues to decline and economic data continues to deteriorate within the within the eurozone, and at the same time in the US, we're still getting a very high non-farm payroll figure. We're still seeing salary growth, and we're still seeing very sticky inflation and even a rise in inflation. And of course, if we can really see a tip in the scale where demand is likely to potentially arise. Now, if we switch to a different time frame again, I can see somebody says that his vision is blurry on his screen. Maybe try and refresh, because from what I can see from everybody else, it's clear. So maybe try and refresh. Otherwise, please let me know and I can have another look at it. Now, if we're going to switch to a different indicator. Here we've got two different indicators. Here we have what is known as a regression channel formed from moving averages. And here, ladies and gentlemen, we have a stochastic oscillator. Now, if we're going to look at this, what we're actually seeing is the regression channel is not widening, but it's thinning. Now, if we're going to see an active signal, we would need to see the regression channel widen like in this area here. So for example, here we had a lot of volatility, a lot of upward volatility, and the regression channel starts to point upwards and you can see it's widening and the price is able to maintain momentum upwards. Maintain momentum above the regression channel. So there we have a signal of direction in the market. Until we start to drop within the regression channel, and that's when we get a signal that it may lose momentum. In which case we can see it does lose momentum, starts to move sideways. So keep that in mind. We're not seeing that at the moment. We're seeing that the regression channel is very thin. It's understandable that it's thin because we're getting volatility in both directions of the market. So to be honest, it is understandable. But again, if we gain momentum, if we start to break upwards, if we break to a higher high, even though that's not what is actually being signaled by inflation, then it's something that we need to take into consideration. But again, you have to be very cautious about that because inflation is higher than expected. When inflation is higher than expected, then of course there may be refusal from the central bank, from the Federal Reserve, and the Federal Open Market Committee to vote for lower interest rates. So instead of seeing lower interest rates in May and in June, it may be in the later months of summer or even in autumn, in which case the market is incorrectly priced, especially when looking at the dollar and especially when looking at the US stock market. And also, especially if we see consecutively that inflation remains sticky. And in terms of technical analysis, even if we are going to get indications of upward price movement, we can see a lot of resistance here. So there's a lot of resistance, ladies and gentlemen, between this area of the market. So as the price increases, we have three areas of resistance, potentially even four. So again, we really have to be cautious about that because it creates a different psychology for traders as traders are speculating the price increase. So again, we have to be cautious with that because inflation was definitely higher than expectations. If the price does lose momentum, then especially if it's going to drop below the regression channel, we can see potentially a different type of price movement develop there. Now, if we go to a different currency pair, and then we'll look at commodities, and then we'll look at equities as well. If I look at, for example, the US dollar against the Japanese yen, we can see that price rejection as well. This is very interesting because you can see again it's moved up to that uh, resistant level, which is our trend line here, and it's moved just below the neutral level. So you can see exactly why I'm using this setup, how that resistant level, the neutral level, how the set price sentiment line where we get an indication where buyers or sellers are controlling the market, how that really can be helpful in obtaining indications and signals. Here we can see that, and especially keep in mind, the Japanese yen is the only central bank within the G7 group which is expected to increase interest rates. The only member. So, taking into consideration that it's the only member, a lot of actual economists and analysts have stated that the Japanese yen may be the most resilient currency of 2024. If it does continue to be the scenario where it's going to be the only member of G7 which is going to which is going to increase interest rates, the only member which is increasing interest rates and is a safe haven asset. And of course, if the Federal Reserve does start to cut interest rates, it starts to lose its importance as a safe haven asset and as a hedge against inflation. And the third aspect of it is that they're increasing interest rates while everybody else is decreasing, and the yen is extremely, extremely cheap. So before we go back to this time frame here, ladies and gentlemen, if I go to a 1 week chart, you can see we're at a point where the Japanese yen has collapsed already on two occasions, now on the third occasion. And we can see exactly how cheap it is. Look how high the US dollar against Japanese yen has increased. And that is something that you are able to see no matter what currency you are looking at. But let's go back, ladies and gentlemen, to the 2 hour. So we really, even this is a different scenario to the Euro USD because we've got a currency which is actually seeing strong economic data, and we've got a currency which is actually getting indications that the US dollar against Japanese yen is still going to continue to decline because we're still in the neutral area, we're still below the 75 bar exponential moving average as well. What we can also do in this area is, of course, we can draw our Fibonacci level here. I'll just switch on to a smaller time frame for this so people can really see clearer the Fibonacci levels. So if we look at the Fibonacci levels here, we can see the price is below the neutral. So even though we've seen a retracement, not a correction this time, but a retracement upwards, we can still be still below the 50. So we're still below the neutral. Even if it's going to move up to 61.8, it's still, even though it's not below the neutral, it's still within the retracement zone. So even if it's going up to this level here, the Fibonacci still indicates it can regain momentum downwards. Now, what I will say, because somebody's asked something here, which is quite an interesting question. He says, what can I do to help me analyze currencies? Now, when we look into analyze currencies as beginners, we need to understand that a lot of beginners look at a currency pair as a single asset. It's the US dollar against Japanese yen, a single asset. Whereas when professionals and institutions are looking at a currency pair, they actually view it and analyze it as though it's three different assets. The first asset is, of course, the US dollar against Japanese yen. So that's asset number one. The second asset is the US dollar index. And the third asset is the Japanese yen index. Now, some people don't have access to indexes. Of course, we have access to indexes for free on HFM's website and MT5 and MT4 and the mobile platform as well. But if you don't, then what you can very simply do is check the main currency pairs for the US dollar and the main currency pairs for the Japanese yen as well. But what we ideally want to see is a currency. We've got two currencies, and of course, we analyze it as one asset. But in addition to this, we ideally want one currency increasing in value with the other currency decreasing in value. So we want no conflicts there. We want no tug of war scenarios. Whereas if we look at the currency pair where both currencies are increasing in value against the market, it can be more difficult to determine how the price is likely to develop. And if it is more difficult, then it's actually more difficult for you to determine what direction the market to trade and when to enter and exit as well. So we have to always look at a currency pair as analyzing three different assets: the exchange rate, one individual currency, and the second individual currency. So, for example, if we're looking at the pound against Japanese yen, if I look at this, for example, which is unrelated to the US dollar, what I would do is I'll check pound currency pairs. So, for example, here I'll look at the euro against the British pound. I can see the British pound is declining against the euro. Then I'll go to the pound against the US dollar. I can see the pound is declining against the US dollar. And then I'll go, for example, the pound against the Australian dollar. This is just an example, ladies and gentlemen. And I'll do the exact same and see that the pound is actually declining against the Australian dollar as well, for example. And we can see that as this scenario here. And then what I'll do is I'll do the same for the Japanese yen. Japanese yen against the euro, it's actually seen mixed price movement. Japanese yen against the pound, we can see is declining for sure, and so on and so forth. And what you want to see is a scenario where one currency is increasing, one currency is decreasing in value. So we want buyers to be maintaining control of the market and sellers to be maintaining control of the market as well. So this is something that people can do in order to assist them with analyzing currency pairs. Now, as promised, of course, we're going to look at the Nasdaq. We're going to look at the Dow Jones as well. I won't look at the S&P 500. Most likely, it's going to be very similar to the Nasdaq. And then we'll look at commodities as well. Now, here we can actually see that the Nasdaq is seeing reverting market conditions. So if anybody's trading using mean reversion and strategies like this, it can be potentially very helpful because you can see the Nasdaq is unable to maintain higher highs or maintain higher lows. We can very clearly see that it's finding resistance in this area of the market here, sometimes slightly above. And we can very clearly see that the price is also struggling at this level here. So if anybody's looking for mean reversion level, potentially looking to aim for the 75 bar exponential moving average. Some people also use the 100, the 125. That's you're more than welcome to. For example, I can change this to 125 like this and use that as a target and trigger point as well, and so on and so forth. But at the moment, I'm going to be using the 75 bar like so. Now, if we're looking at indicators and this setup, it's very clearly in terms of price action indicating that the Nasdaq is appropriately priced based on investors. But we also have to take into consideration, and the reason why I say the price is indicating that is because we're not seeing a specific direction in the market. It's just maintaining the current price range. And this most likely is because investors believe this is the intrinsic zone of the market. And this is where the intrinsic price is. This is what is known in the market as the equilibrium price. But if we look at technical analysis, it's actually indicating that there's a slight tilt towards sellers control in the market. Number one, we've got a higher low, even though we don't have a higher high. Number two, we're trading below the 75 bar exponential moving average, just about. And number three, we're also below the RSI neutral level as well. So this is indicating to us that the price isn't in any trend, so we have to be cautious about that and maybe take into consideration keeping to shorter term trends and shorter term trades rather than longer term, because we're not seeing a clear longer term trending condition. But the indicators are tilting more towards a decline rather towards an upward price movement. If we switch to a 5 minute time frame, we can use our Fibonacci levels again. At the moment, we're in a positive zone for both the MACD, the RSI, and crossovers. The latest crossovers upwards, even though most likely, originally was downwards. And we're currently very close to that neutral level. So we can see we're between the 61 and the 50. So that's potentially, again, indicating a very neutral signal. But what we need to take into consideration as well is that the US market is yet to open. The market's going to open very soon in the US. So when the market opens, then we can start to take into consideration how investors are trading, if they're going to start to speculate the price is going to decline, and so on and so forth. I can see somebody's asking a question. Please bear with me and I'll answer that question. It's a very good question. Now, if the price gains downward momentum, because we can see the latest candlesticks are decline instead of the current one, which is switching from up to down. We can see if it continues to decline, we will get a crossover and we will drop below the neutral. So that's a scenario where we're going to start to coincide with this signal here as well, ladies and gentlemen. Now, if we're going to look at our at our regression channel and look at that moving the Nasdaq, so the US 100. You can see again the regression channel is thinned. So again, we have that neutral area on the regression channel. Ideally, we want to see the regression channel widening like this, and the price trading below or widening upwards and the price trading above. That is where the indicator is that there's enough momentum in the market to see a specific trend in one direction. Stochastic oscillator again moving sideways, and neither seen a crossover upwards or downwards. So again, another neutral signal. So in regards to this, ladies and gentlemen, most likely we're going to need to see a the open of the US session, where more volatility, more traders will enter, and we will really begin to see there, ladies and gentlemen, how the price is likely to develop over the coming days. The announcement, though, was definitely something which is negative for the stock market. If we're going to follow theories, economics, and so on and so forth. Now, somebody says, what fundamental signals can I use? Rather than technical signals. This is something which is very helpful. So if you go to Google, I'll actually do it with you. Bear with me. And you type in NASDAQ components like this. And you click here on the first website which comes up. What it actually does here, ladies and gentlemen, is it gives you because of course the Nasdaq is what is known as a weighted index. A weighted index basically means that certain stocks are more influential than others. So, for example, the Microsoft stock has almost 9% of the index, whereas if I scroll down, if I look at Vertex, it's not even making 1%. So, of course, Microsoft is a lot more influential. So people look at this and people have different theories. Some people look at the top 10 influential stocks here and analyze these stocks. Some people will look at the top 20. Some people will look at all stocks which hold 1% and above, which is the top 24 stocks. Now, what they do is they will look at this area here. So they look at if the stocks are increasing or decreasing. For example, if 80% of stocks are increasing in value, then they will use that as a fundamental signal to indicate that the price of the Nasdaq is likely to increase. If 80% are declining, then of course look at signals where the price may decrease. If it's 50-50, then of course they're not going to, at least at the neutral area of the market. At the moment, if we're looking at the top 20 stocks, only two stocks are declining in value, and that's Alphabet, Class B and Class C. So of course, we can really see here that there's more buying than selling going on, ladies and gentlemen. So this is actually contradicting what we were previously looking at the market when looking at the RSI. So when looking at the Nasdaq. So we need to again be slightly cautious about that. But of course, there's definitely a lot of demand there for the Nasdaq. Has been so far this year anyway. So this is something people can use as well. Another thing people can use is, of course, bond yields, which have more of a medium-term effect. If bond yields are increasing, massively increasing today, up 75 points, ladies and gentlemen. Sorry, 25 points. Uh, it tends to indicate that there's pressure on the stock market. The other thing people can do is look at the CM Watch tool. Somebody says if we can look at gold, yes, we'll look at gold now. This, ladies and gentlemen, gives you indications of whether we're going to see higher or lower interest rates. So, for example, here we've got 60% chance of lower interest rates in June. If that starts to decline, okay, unless people think that there's going to be a cut in June, then again, it can have a negative effect on the stock market. So, because we're running out of time, we've been speaking for almost 40 minutes now. Let's quickly look at gold to make sure we've looked at both currencies, equities, and commodities as well. When we're looking at gold, we're looking at a downward price movement. It's understandable because, of course, there's potential now that interest rates will remain longer. Higher for longer, but of course we need to take into consideration this might be a temporary decline. In terms of this, ladies and gentlemen, we're still above the 75 bars. So at first, if you are going to speculate decline, potentially this will be your target. If it continues to maintain momentum after that, then, ladies and gentlemen, you can use Fibonacci levels for more breakouts, more targets. For example, if you want to look at a significant long-term retracement, then of course you can aim for the 2091 and so on and so forth. So at the moment we have signals on the 75 bar in terms of target. Otherwise, we can use the Fibonacci for the latest upward swing. Um, when we're looking at the RSI, ladies and gentlemen, we're at that neutral level. Now, we're slightly below it. Doesn't necessarily mean sellers are controlling the market at the moment. It just potentially may mean, ladies and gentlemen, that there's current weakness in the price. If the price drops below the 75 bar and we're still below the 50, which is the neutral level on the RSI, it's in that scenario there where we may get stronger bearish signals materialize. So this is for gold, ladies and gentlemen. But like I always say, keep in mind, we always say the US session is about to open. When the US session opens, this can potentially change. We definitely will see more volatility. Of course, you can take into consideration pending orders if you want to. In regards to that, also trading stops if you're already in profits from trades that we've been doing since the beginning of the session, since the data was released. So, of course, we can take that into consideration. Um, but, though, ladies and gentlemen, like we will say, wait till the US session opens. We may see a change there. more volatility, more trades. If anybody's using order flow analysis, if you've got more experienced traders, then of course order flow analysis will really start to become clearer, such as delta statistics, such as the volume weighted average price. That really starts to become more clear, normally about 30 minutes after the US session has opened. So that brings us to the end of today's live analysis. We've stated very clearly uh, in terms of indicators where we've seen buy, where we've seen sell, where indicators are currently still at the neutral level. And of course, that's understandable because the US session, again, is yet to open, hasn't yet opened. And in addition to this, we've looked at the actual release itself. The actual release indicates inflation is stickier, inflation not necessarily may rise, but inflation is very sticky and it's going to become more difficult to tackle. So, what needs to be done in order to tackle inflation is interest rate cuts over the next 6 months now off the table until we ideally start to see inflation decline again. Is the Federal Reserve going to start to become more hawkish? Or is this just a hiccup in the road? A lot of the time, we always see economists say there's a path towards reaching our target, our inflation target. We will reach our inflation target, but there's bumps along the road. So, is that the scenario now? Or if we start to see that this is a reoccurring scenario consecutively, then that's really where we're going to see big market movements in the market because that's when really we start to see a change in how investors start to, should we say, price the market. So that's the end of today's session. If you want to see more analysis, if you want to get free signals, if you want to trade swap free, because of course, US dollar pairs, you can trade them swap free with no swaps on our website. If you want to get unlimited access to educational material, because of course we have many webinars where we look at strategies, even webinars for more advanced traders, for example, individuals more interested in order flow charts, in cumulative delta, and etc. People want to take their trading more further, then of course sign up to our website. It's for free. You get a demo account. You get access to all this advanced trading tools and swap free trading, low spread trading as well. You can sign up for free. In the meantime, enjoy the rest of your day. Trade safely. Trade responsibly, as always. Hopefully, we found today's live stream educational and informative. In the meantime, though, we'll speak again very soon. Our next session, live stream session, is actually on Thursday, where we will be looking at the PPI release and retail sales. In the meantime, goodbye.